Welcome, everyone. See everyone joining here. We'll give everyone a few moments to get started or to get into the webinar before we get started. So we'll just hang tight and welcome. See some familiar names here. So we have a lot of attendees that have attended, this is our 5th session. So thank you all for joining. Like seeing repeat attendees.
I think the first thing on our agenda here is some awkward silence while we wait for everybody to get in the room.
Hold me back, Justin. I'm ready.
I always like to get a reminder of how big that bull is on the back of your wall, Jason.
Yeah, it's a monstrosity for sure. There you go. That'll fill some awkward silence.
There you go. The bull is big.
The bull is big. The bull is back.
All right, we'll give everyone just one more minute, and then I'll go over some housekeeping items and just a few reminders, and we'll get started after that. So just hang tight. I like to see the participant head count just settle down a little bit for folks joining. So we're about there. All right. Well, thank you all for joining this morning. This is the 5th masterclass out of 6 of them. And as a friendly reminder, we have the Q&A at the bottom there. So if you have any questions throughout the webinar, please submit them in the Q&A. And if you see a question in there that you would like to have answered, please upvote it. In the chat there, we will drop some helpful information. A lot of people ask, is this recorded? Or where can I find the how to register for the next one? We do have that on our website, and we do have it, we do send it out as a follow-up. So just know that that information will be provided afterwards. Also, at the end of this webinar, if you haven't already submitted your CFP number, please submit that in the survey at the end of this webinar. As a friendly reminder, you must attend at least 50 minutes to get CFP credit. And then, there was one more thing there are some people that ask for other types of certifications for like the RICP certification. So please put that in the survey as well if you're looking for a certificate of attendance. And I will send that out to you afterwards. So I think we've given the housekeeping items. If you have any further questions, as always, pop them in the Q&A, and I'll pass it over to Justin.
All right. Thank you, Taylor, and welcome everybody. Hello, Jason. Good to see you again, my friend. Back for session 5 of the masterclass. We just have one more session left in 2 more weeks. Knock it out before 4th of July. So hope everybody can get to that one as well. If you are looking for any of the past materials on the sessions before, please check out the website for the masterclass. There's tons of stuff there, including full recorded videos of those sessions. Plus there's some bonus material, some extra videos. So we're doing our best to cover, a lot of the questions people have asked that we weren't able to hit. Today is part 2 of Tax Smart Distribution Planning. And we're going to cover a lot of the materials that cover some of the questions that you asked last time, but we didn't get to. But just to do a quick review of part 1, just so we know where we're starting from. Jason talked about, kind of where the value in tax smart distribution planning comes from an analytical standpoint. What are the things in life that make this kind of planning so important and valuable, which are the 3 tax torpedoes. One is required minimum distributions, which will force, I think the best way to think about it is it forces taxation. Really, you don't have to spend required minimum distributions, but you do have to pay taxes on them. The second is the widow's penalty. So if one person in a couple dies mid-plan, the tax rates, the tax thresholds go from married filing jointly to single. which are lower, so you'll be paying higher taxes. And the third is beneficiary taxes. So considering, what kind of asset is being inherited by someone and what that person's or those people's tax situation is. So if you have, high income kids, for example, that can be a big tax torpedo. And that's where kind of the analytical bang for the buck comes from in tax smart distribution planning. We talked about the steps in Income Lab for doing tax smart distribution planning which is you take a plan, that you've built using the method, the process that we went through in the first 3 sessions, and analyze it in Tax Lab. So that really gives you an automatic view of what would this plan look like if you distributed the assets in all these different ways, including Roth conversions. Easy, one step, no extra work. And then choose a distribution strategy. That may be essentially the end of the story there, but we then talked about how you then reevaluate, especially if you're doing Roth conversions, do those Roth conversions cause enough extra taxation that now net spending is no longer enough? If it is still enough because you had a big surplus and how much you could spend, you just weren't spending it all, you're done. If it's not enough, then we talked about how you can create a plan that targets a net of tax spending level and grosses up the withdrawals in those Roth conversion years to cover the taxes. And so that's kind of the main choice point in this process. We talked about the different withdrawal strategies that are covered in Tax Lab, including pro rata, which is basically pay no attention to taxes, tax ordered, which is probably the default that you'll hear out in the world, taxable, tax deferred, tax free, that kind of thing, and bracket management. We covered this, but there were a lot of questions on it, which is, okay, how are we looking at taxes in the app? And the key is we want to take into account everything that relates to taxation. So we're not, just looking individually at ordinary income tax at the federal level, for example. We want to take everything. We wouldn't choose a tax strategy because it minimizes ordinary tax if it also, maximizes some other tax to counteract it, right? We want to look at the whole picture. And so we're covering FICA, ordinary tax, long-term cap gains, net investment income, that's the ACA tax. Medicare IRMA, we treat as a tax because it essentially is state and local tax. We talked about how to evaluate plans in Tax Lab. So the core being, if you are asking the question, how much can I spend? You will see a difference in total net income and total net legacy. And so the two of those are your, that combined, that's the added value. If you are choosing a how can I spend X plan, you're targeting a specific net of tax income level, then there will never be a difference in total net income because you have pegged that to be one thing. But so all of the value of tax smart distribution planning will be measured in the net legacy section. I think with that, I'm gonna, before we get into some other question or some other topics for today, I want to take some time to review kind of Jason's section of last week. And kind of ask you, Jason, for, kind of some of your key observations or, principles that we shouldn't forget when we're doing tax smart distribution planning, kind of what's all this about and what should we have our mind on?
Yeah, so first I want to acknowledge, looks like we've got some people using AI technology to take notes. So it looks like we've got some tech advanced folks, which I'm sure they'll appreciate Income Lab. We're certainly tech advanced in that department. But you think about it, I started this kind of approach when I got my RICP back in 2018. And when you think about decumulation, this is an extremely important place to focus to improve our clients' plans, affect their lives, and ultimately, not to mention, really impact your business. And so, the way I think of it is just take a step back. We've got accumulation, that's building your wealth. We've got decumulation, that's living your wealth. And, what I've learned over the last decade in general, plus working with clients, is retirees really remain frugal in their retirement. And, they oftentimes don't give themselves permission to spend. And so this tax smart distribution planning has helped my clients really pivot from this more scarcity mindset to a mindset of abundance. And how do they leverage these dollars, the balances in their accounts and or the taxes that they save, to really start to pursue some of their goals. And so at the end of the day, my goal for clients is to have them say, I'm glad I did versus I wish I would have. And so this is all interrelated to ultimately Income Lab, whether that's guardrails, whether that's, Tax Lab in particular. But I think of an example that I think will really resonate. And that was a client that I had was a senior leader, retired from a Fortune 100 company, and well-respected industry leader, had an impeccable balance sheet. Like many folks, did a really good job saving, investing, saving, investing. And frankly, his resources far outweighed his spending capacity. And he lived pretty modestly. Sure, he'd take a family vacation once a year, rent a house on the beach, but other than that, was quite modest. And so, like many in this demographic, he was really underspending his resources. So cut to a year ago, he's diagnosed with a rare illness, and he starts to question kind of his mortality and ultimately what the future holds. And so he had a desire to be closer to his loved ones, specifically his grandchildren. He wanted to have a better relationship with his grandchildren for the remaining years he was going to have on this earth. And yet, even after this health event, it was still difficult for him to shift his mind to truly live as well. And so let's put a pin in the story for a minute, and let's just talk about, how do we help clients live their wealth? Well, I think it's fair to acknowledge that the folks that are registered and with us here today, they've probably thrown away the napkin. We're not doing the back of the napkin calculations anymore, Justin. That's long gone. The spreadsheets, financial world's far too complex to rely on paper calculations and spreadsheets. But I think it's fair to assume that our audience, this audience with us today, has really evolved and more planning focused. And so the difficulty with the mainstream financial planning software that I found was just kind of the inadequacies around attempting to model distribution strategies, right? Your conventional strategy, your pro rata strategy, the tax bracket strategy, dynamic, time sensitive. Of course, we've got tax planning. That's going to be, where do Roth conversions fit into the equation? What tax brackets should I target? Are Roth conversions still advantageous if they extend Tax Cuts and Jobs Act? I know we hear that a lot, right? And then also, how does these Roth conversions, how do they impact my Medicare premiums, my IRMA brackets? What about these RMD tax torpedoes? And, when it comes to generating income, there are really a number of methods and strategies that we can consider. But what's been really enlightening to me, since utilizing Income Lab and Tax Lab in particular, is where we're able to run various analysis to kind of determine which strategies are optimal, or combination strategies maybe that are optimal. And so to compare and contrast, okay, here's what a client is doing currently, or maybe a prospect. Here's their current approach, their current distribution strategy, their current tax planning strategy. But what if we compare and contrast to this tax smart distribution? And so this is where I'll kind of add what I call phraseology, and where I think this is helpful with some scripting. And that is, if you have a client in front of you, and if you are to say, if you follow your current path, it is slated that you'll pay about $907,000 in cumulative taxes over the course of your plan. And it is anticipated that you're tipping the government by about $338,000. That is the difference between the current strategy versus the proposed strategy, right? And so, I asked the question, is that by design? And, how did this strategy come to be? And ultimately, the answer is they likely don't know, right? And so, quantifying how tax smart distribution planning can reduce a client's tax bill is one element. But literally, let's take it a layer further. And that layer further is, how would this $338,000 reshape your family's life? What would you do with this money if we were able to help you save these tax dollars? And this really opens up our client's mind to the possibilities. And in my client's case, it opened up their eyes to really a whole new way of living, a whole new way of thinking. And that's what, Justin, we've coined, kind of living your wealth. And, he's always wanted to spend more time with his children and grandchildren. But since utilizing the software, we were able to put together, this tax smart distribution strategy, layering in Roth conversions, and to demonstrate and quantify, here's the total taxes you're tipping the government with the current strategy versus a new approach. And so that ultimately gave him the confidence to pursue some of these goals and actually purchased a condo near his grandkids, watches his grandkids 2 weeks out of every month, and really gets to spend time with them without the planning that we had done together and the psychology and the conversation, behavior type conversations. He probably never would have felt confident enough to embark on this new condo and getting that quality time that he so deeply deserves and desires.
I think that's such a great takeaway, especially for those of us like me who can be very analytical. Obviously the analytics are a huge value. And like you said, the tax system is so complex. This can't be back of the napkin stuff, but you have to connect it with someone's actual life and what this means for them. So I think that's a great, some of those, that wordsmith thing is really great and an important part of this, right? It's not just throw some numbers up on the screen and there, see, we gotta do a so what here. All right, so let's get a little bit into some of the more advanced stuff for part 2 here. And actually, some people have already asked questions in the Q&A on a few of these topics. So let me just review a little bit. I mentioned, the 3 kind of buckets of strategies that we have: pro rata, which is the pay no attention to taxes, tax type based, so taxable, tax deferred, tax free, for example, and then bracket management, where we do Roth conversions up to a particular bracket. A few people had questions on kind of why by default are we comparing Roth conversions to taxable, tax deferred, tax free. The reason is this is really apples to apples, because you're behind Roth conversions, you're doing taxable, tax deferred, tax free. And the reason for this is just, analytically, that's the best way to do it. There are some questions in here about, are there other things that Income Lab will add to the Tax Lab? Yes. So the one, or actually 2 that people have asked questions about that are coming, are adding IRMA brackets to this list, to the bracket management list. So not just ordinary brackets, but IRMA brackets, and also a lump sum one-time huge Roth conversion, just so that you can compare that. We also have people asking about, what about bracket management but not doing Roth conversion? So basically spending the money instead, or moving it to a taxable account, or maybe only doing up to that bracket if you're spending more and then taking from taxable. That is all doable, and we may add that at some point. The main reason we haven't done it so far is basically like that will always perform worse than Roth conversions. So if you're taking the money out up to a bracket, putting it in a Roth is going to be more long-term tax efficient than putting it in a taxable account and spending it. So that doesn't mean that it's not something that we will add someday or that you might want to consider, but that's the main reason that we haven't added that so far. All right, so that kind of covers some of the basic questions that people have already been asking. Another bit that I'll just ask before getting back to Jason here is, how are we paying the taxes in this? So to kind of set this up, what you're doing in Tax Lab is really you're saying, all right, I have this plan. This plan includes spending some of my portfolio money. How should I source those withdrawals? And should I consider Roth conversions? By the way, just presenting that as like to a client, from what I've heard, that is a basic question, right? That is just a, hey, how am I living on my money? How am I developing this? And it's amazing. A lot of times clients and prospects won't have had that question answered before. So, don't underestimate just how framing it in that simple way can actually help them. But one question then will be, okay, if I do Roth conversions, for example, how will I be paying the taxes? So here's how Income Lab assumes that everything will be sourced. So first, we would be paying taxes from non-portfolio income. If this is one of those years where there's some big, income event, or maybe somebody's still working and has wages, right? That's the first source of paying taxes. And the reason is you already had to pay taxes on that money. So it's post-tax money. It's the most efficient way to pay taxes. Then it will pay the taxes from non-deferred accounts. So that's typically going to be a taxable account. Or actually, another way that it would pay the taxes is if you had money that's already being forced out of an account. So maybe it's non-qualified deferred comp, where you're getting money. I would think of that, it's almost like non-portfolio income, right? It's just money that's going to hit your account. You're going to pay taxes on it, right? Maybe you're distributing some money from an inherited IRA, right? It's going to pay the taxes with that. And only finally, once you've exhausted those options, would the software assume that you would pay the taxes from tax deferred accounts. In other words, you would net out the conversion. So you might take, $100,000 from your IRA, but only 80,000 hits the Roth. So that's sort of this waterfall that's assumed behind the scenes in kind of how the taxes are paid in a Roth. Even if you're not doing a Roth conversion, this is how we're assuming that the taxes are going to be paid. Again, because that's just analytically the most efficient way to do it. Let's see here, a few other questions I'll hit. We've had a lot of questions around kind of fine tuning and a plan. So I want to take a little bit of time to go over a few of those options. Let's see here. And this is basically, as the example we just went over, where there was, almost $350,000 in today's dollar value for this client. That's sometimes at the end of tax planning. There are other pieces where you can kind of fine tune a plan to add more value. One big one is qualified charitable distributions or qualified charitable deductions. So that's taking money from an IRA at age 70 and a half or thereafter, and sending it directly to a qualified charity. So I've created some plans that we can look at here. So for example, what I did here is I created a plan. It's fairly straightforward. It has some taxable money. It has an IRA. And I'm going to compare it to, and I made it spend $10,000 a month net of tax, just so that for this example, we can just focus on this number and see all of the value, kind of in one place. So what I'm going to do is now compare it to another plan that I built that doesn't have the QCDs. So it just has, and I'm going to compare Roth conversions to the 24% bracket for both plans. So this is a thing many people may not have noticed, is you can compare two strategies for a single plan, or you can compare two different plans. You can even compare different strategies for different plans. In this case, I'm going to use the same strategy. Both of them Roth convergence to the 24% bracket, one with QCDs, and I also put a floor on the so I'm telling it not to convert every single dollar in my IRA. I'm a little bit for my RMDs, kind of let me take out some RMDs later. And you can see completely apples to apples, right? Because I'm doing the same Roth conversions. I'm adding an extra $270,000 in value by having some QCDs. I'm not maxing out the QCDs here. I think I put in, we can check it, but I think it's like, I think it was just $12,000 a year. So, you know, not even close to the max on the QCDs. But wow, I mean, that's a pretty big deal. Because remember, if I go back to comparing, right, just this, that QCD and floor is really adding a lot of value. So how do I access those kinds of, you know, advanced tax planning? I go to the plan's advanced settings, and the very first section is taxes. And I got a lot of goodies here. So, for example, here, I've said, hey, don't let Roth conversions or tax ordered withdrawals take my tax deferred balance below $400,000. This is also a place where, you know, I might have a client who says, I would never do a Roth conversion more than, you know, $50,000 or $80,000 in a given year. And that may not be the most efficient thing for them, but if it is a strongly felt thing, you're going to want to be able to reflect that. This may be a place where if there are years when a Roth conversion would not be a good idea because maybe you're pre-65 and you're trying to get ACA credits against health insurance, this would be a place where you'd want to, you know, customize the years when it's allowed. Maybe, you know, for the first 3 years, I'm in that position, so I'm not going to allow Roth conversions those years because I don't want my income to creep up, right? So these are the kinds of things that you can specify here. Let's go to LifeHub and have a look at where you can see the charitable expenses. So I'm only going to get those once I hit 70.5. And so finally, I guess this person didn't turn 70.5 until the very end of the year. So this is one where we treat QCDs only as available literally once you turn 70.5. It can't be the year of. So I get by 2030, I get my full QCDs. And so you see I'm sourcing some of my income that's going to come out of my IRA tax-free to pay for those charitable giving. And that's basically it's another way of getting some money out of, in this case, only IRAs, but out of tax deferred accounts, tax-free. That'll actually also work for inherited IRAs, by the way, so you can still do QCDs there. So those are a few of the kind of advanced approaches that, you know, people have asked questions about today, but certainly in the past as well. And all of them add value to one that somebody brought up last time, but we didn't talk about today, is Social Security timing. So this is a place where if you're going to do Roth conversions, delaying Social Security until later, typically after the Roth conversions, will have kind of a multiplying effect, because now the taxability of Social Security will be much lower once you're kind of done with those Roth conversions, because your the combined income that's part of the Social Security calculation will be much lower. This is a really important thing that surprisingly a lot of times is not taken into account in this kind of analysis. So you'll often have, you know, software that's not so focused on retirement taxes, just asking you, hey, what's your Social Security taxability going to be? You know, let's assume 85%. Well, that's ridiculous. You know, the software should tell you what the Social Security taxability is, not the other way around. And many times, even with fairly high income plans, it is not always capping out at 85%. There's, you know, that calculation is fairly complex. Social Security taxability brackets are not adjusted for inflation. So later in the plan, they'll be more taxable and so on. This is a thing that needs to be done correctly. And so you definitely want to make sure you're taking in Social Security taxability into account in the best way that you can. All right, so that I think covers some of the main kind of more advanced questions that we've had. I can cover a few more of them in my next session, but I want to get back to some of the things Jason mentioned there. In particular, you mentioned, just as one of your examples, the Tax Cuts and Job Act sunsetting. That, along with some other questions we've gotten about kind of the uncertainty of future tax rates, uncertainty of things like, changes in Roth rules. There are a lot of kind of theories out there about what the future could look like. How do you, Jason, address just the uncertainty of the future in general when you're doing this kind of planning?
Yeah, I think it's important to acknowledge that life is an evolution, the government is an evolution, the tax code will be an evolution, and unfortunately, we only know the current IRS tax legislation. So we have to work off of that. Now, that said, I usually will talk a little bit about the government in general and just the idea of the federal deficit. And what relates with most of my clients who are entrepreneurs and business owners, senior leaders, is the idea of business. And we need to have more revenue than we have expenses in order to balance our own budgets within our homes, in order to be successful within our advisory companies, RA or whatever your firm is. And so, as you think about the government, revenues are taxes. And expenses are spending, and spending far exceeds taxes. Expenses far exceed those revenues. And so I'll just ask a simple question, and that is, do you think taxes will rise or fall in the future? And I do a lot of webinars, seminars, those types of things. I've had, well over 1,000 registrants just in the last few years. And I've only had 2 people that said they thought taxes would fall. And so then the follow-up question is, if we do believe taxes are going to go up in the future, would you rather pay taxes today or would you rather pay taxes tomorrow? And this is where the psychology comes into play, right? Because the value of $1 today versus the value of $1 tomorrow, this is where clients run into a little bit of trouble. And so what I like to do is I believe in taking away the objection before it's an objection. So I will actually mention the idea that the tax code is evolving. The tax code is ever changing. Tax Cuts and Jobs Act is set to sunset in 2026. Do we know if it will be extended or not? I can't confirm that. That said, with the current legislation in place, here's the outcome, here is the results, here's the quantification. And, like I said, I believe in kind of taking away the objection before it's an objection. And it reminds me, Justin, we were talking about this the other day, for you who can't see my lower body, I have skinny legs, okay? And so people make fun of my legs. And what I do is I actually take away the humor from them so they can't use it against me. It's kind of like that, if any of you seen 8 Mile and Eminem and how he would make fun of himself while rapping so others couldn't make fun of him in advance. Well, this is similar to taking away that government spending and the idea if taxes will rise or fall.
Yeah, and I think that the other key thing around it, like you said, most people, if you ask them that question, if they've thought about it, they're probably going to say, "Oh, I think they'll go up." Well, if that's true, then that means we're probably understating the value of Roth conversions, right? But under promising, over delivering is no one's ever been too upset by that, right? So it's not necessarily even a problem for this kind of tax smart distribution planning. Yes, maybe in these statistics, maybe this number is lower than really it will be, but that's fine. I mean, we already know that we don't know the future, so the numbers are going to be different than the ones we have here. So I agree. I think making sure you just address it up front if you think it's going to be a big deal. You'll hear a lot of things. I know somebody mentioned that Ed Slott is really pushing higher Roth conversions because of TCJA sunsetting, deficit spending, like you said. Clients I hear will even kind of have some concerns over whether Roths will always be tax-free or something like that. I don't know anything about those, but that's kind of just a cloud of worry that people have. The nice thing is, though, if people are thinking in those terms, except for those rare people who think taxes will go down, all that means is that you're under-promising and over-delivering here. And it also, I think, draws us back to a point that you made last time, Jason, which is that this tax smart distribution planning is not a one-time thing. This is not you give somebody a playbook for the next 30 years, just go do it. It is, we're going to have to review this at least annually, right? So this is really to get the most out of tax smart distribution planning. People should be coming back, right? This should be an ongoing process.
It is. Yeah, it truly is a living, breathing software and a living, breathing document that we just don't print and put on our shelf. And yeah, it's important that as our lives evolve, you know, my life is very different today than it was 5 years ago, 10 years ago, and so on. And our clients' lives are similar. Our clients' lives will be different in the future, and as will the tax code. So we just need to be able to evolve. We need to be able to adapt. We need to be able to adjust and, you know, utilize the current information that we have in its accuracy and move forward with that information.
Yeah. So let's get to this question of kind of making decisions on which approach to follow. And one thing that a lot of people use, and I think, you know, rightly so, is this break-even calculation, which is just cumulative taxes paid, right? So you can see how they're just stacking up over time, right? And this is kind of not uncommon for somebody in the age range of this hypothetical household where it's, you know, 20 to, in this case, 21 years for kind of, you know, the cumulative taxes on these two approaches to match up. And then kind of after that, it's, you know, everything is gravy. Jason, you know, how do you think about break evens, you know, especially given all the uncertainties, not just in the tax code, but also in life, right? Will each person live that long? You know, what about beneficiaries and so on? How do you address that when people ask this question about, you know, when is it worth it?
Yes, absolutely. So usually there's a set of questions in advance, and that is really understanding what some of the top priorities are for any given client or prospect. And as legacy specifically balances at the end of plan as an inheritance to their heirs, is that a goal? Or do they have a target goal, a target number that they want to pass along? And then it is related to, okay, well, as far as, you know, Roth conversions are concerned and that break even, it's a matter of who's going to benefit. Is it going to be the client, or is it going to be the heir that inherits the dollars? And at the end of the day, it's going to be one or the other, depending on a person's lifespan. But just the idea of not tipping the government and keeping as much of our hard-earned money in our own pockets as possible. And whether it's the client's pocket or whether it's their heir's pocket, in the end, that's usually the driving force. Now, you might take it a layer further and say, okay, well, Jason, you know, I have a client that doesn't want to pass along a substantial nest egg and legacy at the end of plan. They would rather gift it with a warm hand and a beating heart. Actually, just got an email from a client a little earlier before the session. And we were talking about the importance of gifting while our children are in need. And he's got a couple adult children. He's got a number of grandkids. And, you know, he's just in a situation where one of his children needs a vehicle. The other children could use some help, you know, with a home remodel. And he wants to be able to gift to them today. And so once again, that just goes back to, you know, what's the purpose? What's the goal? Really understanding those priorities. And that allows you to then position the question on that break-even point.
Mm. Yeah, so one way to think about that is, in this case, you know, it looks like we're doing 6 years of Roth conversions, or maybe it might actually be fewer than that. Maybe it's 4. And basically after that, you're kind of in the driver's seat. Whereas in these years where we have yellow, if you had to, you know, help a child make a down payment or buy it, you know, that's going to have a larger tax hit. So kind of those unexpected expenses, I guess that's another unknown, right? Where you at least freed yourself up from taxes being a consideration after you've done the Roth conversions.
And to your point, Justin, sorry to interrupt there. This just came to me, and that is, you know, in this instance, there's going to be some one-off distributions that we weren't planning for. And so depending on where we pull those dollars from, you know, fortunately they have taxable accounts, and yes, there are some capital gains. Those capital gains are going to come into calculation. We're modeling out those Roth conversions, right? Yep. So it's a year by year. It goes back to your point you just mentioned earlier, and it is a year by year calculation. It's not like we can just hand the client, here's your plan, and you're going to be set it and forget it for the next 7 years. Follow this roadmap, because life throws us curveballs. We have changes, we have challenges, and so we need to be able to adapt.
We had a few questions on net legacy. You mentioned there, like, what if a client is, you know, really they do have some beneficiary desires, or if they're just thinking about the beneficiaries if life isn't as long as they thought it would be. So net legacy calculation here, just we've had some questions on this. How do we do it? This is end of plan. The inheritor of the entire portfolio is a 55-year-old couple, and they cash the whole thing out. Okay. Now, granted, that might not be the most tax efficient thing to do, but we're kind of saying, hey, it's not entirely uncommon. And these days, because of, you know, changes in rules, the stretch period is not necessarily as long as it used to be. But that's what's getting you the net legacy. If you're looking for gross numbers and kind of how the overall portfolio is developing over time, the Explore section, well, first of all, it's just really helpful in general, especially for the advisor. It can be a little much for a client. But if you go to Explore and go to the portfolio, you will see how the taxable, tax-deferred, and tax-free balances are developing over time. You can see, because there's a floor in this case on the tax-deferred balance, we're not ever quite you know, getting it down to zero. But the tax-free balance is here. So if you were curious, well, you know, what if somebody dies in, you know, 10 years, where am I? Well, by then I've substantially reduced my, my tax-deferred balance, right? And these are gross of tax numbers. So you can kind of see, all right, you know, maybe back of the envelope on that $406,000, you know, what might the taxes be? It's very different than, you know, at the beginning. Deferred balance is also quite a bit lower. So this can be a really useful thing. Just as long as we're here, I guess one other place that I'll point out a few things is the income section. If you're ever wondering what all is going on tax-wise in a plan, this is a great place to go. So for example, this dark purple or darker purple is Roth conversion. So I can see, you know, okay, I've got 5 years of Roth conversions in this plan, right? They're just a little mop up in 2028, but otherwise 4 years. You can see, you know, what all is going on in terms of, you know, do I have some, you know, how much am I receiving tax free? So, so the 0% bracket here, you may know there is no 0% bracket technically in the U.S. tax code. So what is that? Well, that's your deduction, your standard deduction. Very soon, Income Lab will be covering itemized deduction. So it's anything deductible. It's, you know, it's those QCDs, it's distributions from Roths, it's anything that's tax-free is down here. So this can also be a great place if you're ever kind of looking to understand a plan. The income tab, and like I said, the portfolio tab, if you're curious about, well, what if we don't last, you know, the entire plan, which is a perfectly reasonable question. You know, what do things look like there? So yeah, this break even is a break even from the living client's point of view. It is not a break even from a beneficiary's point of view. We did have someone ask, can I look at what would happen if a client, you know, if one of a couple passes away, because that is one of the tax torpedoes, That is doable as well. So, I always, as we talked about in the first couple sessions, we usually want to copy plans whenever we're making changes. So, I'm going to say, maybe we'll have, John in 2035 here. So in order to set kind of a firm date of death for one of the spouses, I'm going to go to the advanced settings, which will load it here. And all I do is, instead of using mortality tables to figure out the length of the plan, and instead of using, this, how do I feel about my longevity, right? Am I sort of above average, below average? I'm just going to change John to a specific date of death. I think I said it was going to be 2040. Doesn't really matter when I put it. The taxation wise, John will be alive for 2040. Save it and go back to the plan. So now what's going to happen is basically the plan will totally adjust in this case, 2041, where now we'll be on single tax brackets. We will have, in this case, for example, we're going to have a rollover, a spousal rollover. You can see how nothing, nothing, nothing. And then in 2041, all of those assets go over to Mary. Now they're going to be on her RMDs, right? And if we go to Tax Lab, we'll be able to see the effect of that. So it's a really good question that we often get, and we got today as well. Okay, let me see if there are any other. Let's see here. Oh, somebody was asking, just, is there a way I can set a default tax distribution strategy in the app? There is. So I've been going over the advanced settings for a particular plan. That's where you set all these, special, floors and ceilings and years when I allow Roth conversions and so on. If you're just looking to set overall defaults for your account, this top section, the menu across the top is, think of it as overall stuff. And you can set a default withdrawal strategy. So maybe you have it as pro rata, but you want it to be taxable, tax deferred, tax free. You can make that change here. You could even set, a default floor on the tax deferred balance, so that anytime you create a new household with its own new household plan, these settings will be applied, so that you don't have to make. If you have a kind of a favorite thing to do, that's where you want to start. Now that won't affect any plans you've already created, and it won't affect if you're making a copy of a plan or something. It's going to copy all the actual settings of the plan you're copying, not using your defaults. But that's a good place if you're looking to save some time. Time has flown here, Jason. I mean, absolutely. I don't know if we're
Always.
Yeah. So let me just see if there's any pre-questions. Oh, I do want to hit this one. So let's go ahead and answer it. I suspect some of our 42 questions are related to this. How do you or people on your team work with any other tax-related software or planning-related software? So this is, tax smart distribution planning, it's strategy, it's long-term. I think you're also a Holistiplan user. Can you talk a little bit about that?
Absolutely. Yeah, we use them in unison with one another. So we think of Income Lab, Tax Lab. That's going to be strategic tax planning, whereas Holistiplan is going to be more year by year, more tactical in nature, where we're able to target the specific bracket to the precise figure, where we're factoring in your modified adjustable gross income and how that's going to influence IRMA brackets and all those details. So it is very much a coordinated effort when we're executing and pulling the trigger on the final Roth conversion for the year. I will note, typically we do Roth conversions potentially twice a year. So number one, at the beginning of the year, we'll oftentimes identify a dollar amount that we're going to convert, specifically now since we're under TCJA. And most of our modeling in current state, we will model just Roth conversions. under TCJA. We'll evaluate that result in comparison to Roth conversions beyond TCJA. So that's an important element to note, but then also the idea that every year is unique to our client. Maybe they choose to gift in one given year, and historically we didn't have that in the plan. Or maybe they elect to buy a vehicle. Had one of these, this happens more times than not. I do encourage my clients to live their wealth, which I think that theme is kind of reigning true and has really been echoed over the last 5 sessions. But we will meet and we'll evaluate their resources. And ultimately, most of the clients I work with really don't have this huge legacy goal at the end of plan, and therefore they use those conversations to give themselves permission to buy that vehicle that they wanted to purchase. Had one the other day that purchased his wife a brand new SUV, and it was literally a week after we had a conversation that they had more spending capacity that they could fulfill and utilize. So it's the ongoing process. It's understanding, here's my total Roth conversions for the year. We'll oftentimes execute 50% of that Roth conversion, depending on the market conditions, optimally executing a Roth conversion in a down market. And then we'll execute the other half at the end of the year when we've got a more clear understanding of their distributions, taxable income that has occurred through all their income sources for the first, 11 months.
One other question actually that I think is, we get a lot of questions on. We've talked in this session about some pretty advanced stuff, QCDs, which by the way, I realized I didn't mention how I do that. The way that you do that is simply creating an expense, could be other variable, could be baseline, where the type is charity, right? So you need an expense to match to that. But we talked about QCDs, we talked about floors and ceilings and years and so on. That's all great for the advisor to make sure we're dialing things in. What actual visuals or reports do you use when you're talking with clients about this? Presumably it's not the advanced settings.
It is not. No, it is right. It is right here. It is tax lab, and it's these statistics. This is where we focus. If we get any deeper, it's usually where we're evaluating those tax brackets just to demonstrate, okay, you'll notice here we're targeting Roth conversions, the 24% bracket over the next 2 years. Here's the output. And then maybe we'll do a comparison to say, okay, larger Roth conversions under TCJA, smaller Roth conversions for the remaining 5 years after the expiration of the sunset.
Yeah. And I don't know if people noticed, but I was showing in the advanced settings, there is a place if you wanted to just test out, hey, what if they don't sunset? You can just uncheck that. All right, great questions. Let's see. All right, we have so many questions here. I'm sure we're going to end up doing some videos on this, but there's several that are asking kind of about even more customization. For example, somebody asked, well, can I choose where to pay the taxes from, for periods? A lot of that, I can't go through all, 42 questions right now, but a lot of that will be doable if you simply create a forced distribution from a particular account. As I mentioned, the software will use whatever's already available and that you've already paid taxes on first, because why not? That's definitely the most efficient way. So you can, on any account, you can create a forced distribution by going to account and distribution settings, and then say specify a distribution for this account. And then maybe it's a one-time thing, maybe it's for a couple of years. If you're trying to force one account to pay the taxes, we often get this with like more of a cash account, right? Where you just got a lot of cash there. You're hoping to use that to fund your Roth conversions. Go ahead and do that using this kind of customization of the distribution. So I think that covers a multitude of these kind of questions about prioritizing where you're paying taxes from or how things are coming out. All right. Just a reminder, please upvote anything. We'll definitely be taking a look at these and trying to consolidate them. do some answering either this next session or with a video. All right.
Maybe since there are quite a few, maybe we look at the ones that would be asked towards Jason versus the software.
Yep. Can you find one for us, Taylor?
So Jason, I'm curious how you are explaining paying Roth conversion taxes in practice and how you coordinate with CPAs, EAs, and clients.
Good question.
Yeah, this is a very important element. We consider ourselves, well, our clients consider us oftentimes kind of the relationship manager or the CFO of their financial situation of their family. And so our job is to kind of coordinate with the other advisors they have in place, whether that's an estate attorney, whether that's a CPA or an EA, an accountant, so on and so forth. And when it comes to conversation with accountants, we want to get the accountant stamp of approval. I do let them know in advance. Traditionally, when they approach their CPA to talk about these elements, it might be a coin flip if the CPA agrees with the size of Roth conversion that we're ultimately have determined is going to be optimal. And so I'll just ask a question with that CPA when we get on the line. There's a lot of tax strategies we hear about, Roth conversions being one of those. What's your take on Roth conversions? Tell me, what's your temperature? And I have them inform me of their temperature. And then once I have an understanding of that CPA's attitude, then I'm able to position, transition, so on and so forth. And what I will say is, I'll say 9 times out of 10, it might actually be higher than that. When we show COIs and accountants and CPAs this software, they are blown away. Absolutely blown away. It's unlike anything they've ever seen. And when we go through our process and our approach, they turn into referral sources. They turn into COIs. And so that's why it's really important to go into those conversations with a super open mind and ask them how they feel about these different approaches and strategies. So you can be advocates, you can work together in order to help our client. And that's the end result, right? We want the best end result for our clients as possible. And if there's a way we can keep more money on their plates, the better.
Okay. Then another one is kind of, it's from an anonymous, and you don't have to answer it, but do you charge a financial planning fee for your time in preparing reports and analysis?
It depends on we do 2 different cohorts. We have cohorts that we have AUM style assets under management, and then we have cohorts that just pay us for financial planning fees, just straight financial planning, more do-it-yourselfers. Those do-it-yourselfers that want to continue to manage their own dollars, manage their own accounts and the investments, and they just want us on the planning side, tax planning side, distributions. We do both, but we don't tandem the two. We don't stack them. You're one or the other.
And then Jason, how do you address a client that says, I might pay all of those taxes today and die 3 years from now? Has that come up?
Possibility.
Yeah.
And I think what's really important is to understand what's really an objection versus a comment. Because was there a question or was it just a comment? And you can probe deeper, say, what do you mean by that? And understand where they're coming from. That's really, really important. A question oftentimes solicits an additional question from me. If a client poses a question, if a prospect poses a question, I need to dive deeper. I need to understand their train of thought. And I'm assuming their train of thought if I just immediately go into an answer to address it.
Yeah, that's a great
Well,
point.
oh, go ahead, Justin.
Good place to end, I think. Yeah, awesome questions. And also on that last question, that does get to, maybe they're expressing just a little reticence on, how large that number looks or something, right? I think we've talked about this the last 2 sessions. There's art and science in any kind of financial planning. It can sure be tempting when you see a chart like this. You say, well, hang on, 7.99 is lower than 8.77 or 8.1. Yeah, it is. But you know, these are all saving people money, right? And so maybe that is a time if you really just discover that, oh, it's just a discomfort with a large check coming out of then okay, well, maybe this is the point where you say, hey, let's just do 22, still saves you a bunch of money, we're good. So anyway, I don't know if you have comments on that, Jason.
Well, I would just go back to your point, and it is very much art, and it's really in relation to helping the client or the prospect feel comfortable and feel confident in their decision, and meeting them where they are, and making sure that they can lay their head down at night and get that ROS, that return on sleep. And maybe it isn't maximizing the savings, and maybe it isn't maximizing that 32% tax bracket. That's okay. You know, we've evaluated the options and ultimately come to a confident decision moving forward. And that's valuable.
Yeah, just being able to address that simple question of, hey, this is what I'm doing. Where do I get the money from? Do I do Roth conversions? And show that you have taken that question super seriously. It's not something, at least from what I hear, it is not something that all advisors do. So there is some real value here. And you know, the bad news is the tax system is extremely complicated, but that's also, you know, the good news is it's extremely complicated. So there's a lot of value you can add for a client here. So with that, we're going to take the Q&A, and we will, as we've done in the past, we'll include some in next session. We probably will end up doing some videos to answer some of the others. So I'm sorry we weren't able to get to everybody today, but obviously a ton of interest in this topic, and without a doubt, because of that, something we will return to many more times on Income Lab webinars. So thank you, everybody. Thank you, Jason. This was great.
Thank you.
All right. Remember the survey at the end, everyone. So let's shut her down so that survey will send. Thank you.
Thank you.